Hey, what is up guys, and welcome back to my channel. And for today's video I want to share with you the way I analyze companies before investing in Wall Street. Basically this is we can say the technique that I learned or the way on how I analyze companies. So I hope this is going to help you to understand better understand how you can invest in the Wall Street, how you can pick companies and stocks so you can reduce the level of uncertainty when investing. But before we get into the content, if you like this video, please hit the like button and subscribe to my channel. And also, if you have comments about this video or if you have any idea about future videos, please leave those ideas in the comment section below. So let's get into the content. So now, as you can see, we are now in Yahoo Finance website. So this is the Canadian website of the company. But anyways, it's the same if you are anywhere. So here in the search area, you're going to type the name of the company. In this case, we're going to do this example with Apple because it's my favorite company. And so you type in the name of the company, in this case Apple, and you're going to have here on the left the ticker symbol of the company. And we have to pay attention because there are sometimes there are companies named the same, and we have to pay close attention to which are we going to select. In this case it's the first one. We click that one and it's going to take us to the information, the general information of the company. Here you're going to have the price of the stock at that moment and the variation of the price, and this is the after hours price. And you can see here like a general overview of the company, very general but important at the same time. So we're going to go into only what matters for us in this video because otherwise it's going to be way longer than I expected. So this is the P/E ratio, and basically what it means is that this is the price, or this is going to tell us if the price of the stock of this company is expensive or not. Basically the normal number of this ratio is between 13 to 20. If you see a company in those levels, it means that the price of that company right now is normal. It is good for the revenue it is generating right now. But if you see a higher number than that, basically it means that the price of the stock is expensive right now. It's kind of overvalued. Then this is what it's telling us right now. But also you have to understand that the price of the stock, or basically this ratio, is going to behave according to industries, meaning that the P/E ratio for the stock for the tech industry is not going to behave the same that for example, than the P/E ratio of the oil industry, companies of the oil industry, basically like that. So if you want to know what is the correct P/E ratio for the tech industry, you only have to Google it. Basically, you will find the answer by doing that research very quickly. So this other one is the EPS, and it means the earnings per share. Well, as the name implies, is how much money this company is making with the price for every share. And right now the number is $3.30. So out of this current price, which is $115.17, Apple is making $3.30 per share. So now let's go to the financials, which is what I go to when I want to analyze the balance sheet of a company. You click here in the balance sheet area, and we're going to go straight to the cash that this company has right now. So it says here, for example, Apple has this value in cash, and this is very good because it tells us how much money this company has available right now in order, in case something happened, they will use this money to for example, reduce the uncertainty, for example, or something. I don't know if they have any problems, they can use this money to resolve the problem. And this is the total current assets for this company. We have to see how much assets, what is the amount of assets this company has. So in this case, in the case of Apple, it has 338 billion 516 million. So we can notice here we have data from since 2016 until 2019. So it is important to notice that, well, we should want a company that is been increasing its amount of value over time, in this case assets. But it's not the case for Apple. So if we want to know why over time Apple has reduced the value or the total assets, we can Google it at the same time. So we can look up, like, for example, why Google and Apple is doesn't have the same total assets than last year, for example, and stuff like that. So if we go down, even scroll down, we can see the total liabilities of the company, and this is the total. So it is important to notice here this value, which is the current liabilities. So for the short term, if anything happens, like for example another lockdown and stuff like that, or if Apple all of the sudden stops producing revenue, basically this company can pay the current liabilities almost with the cash that they have available right now, which is very good, because you wouldn't like a company that has a high amount of debt but doesn't have cash, because if something happens like what happens at the beginning of the year, where all of a sudden the revenue of a lot of companies went down. If the company is, for example, in the tourism industry, well, you're going to be hit hard, and you're going to need cash to overcome this situation. So in companies like Apple, it's very important to have a high amount of cash, and this is the case for this company. So this gives me confidence on the company at the same time. So this is the total stockholders equity, which is positive, which is actually really good. So going into more detail, we have here on the right the earnings chart, and basically this is telling us what analysts think about the company. So they make their estimates, and for example, in the third quarter of the 2019, the analysts they estimate that, or in this case they estimated that the company was going to generate 0.71 per share, but the actual value was 0.76, so it was better than expected. And if we take a look at the next quarter, the last one of the last year, the same happened. Apple had more earnings than expected, which is actually really good. This helps to keep increasing the value of the company, and the price of the share is going to keep increasing, which is something good for investors. And now for the first quarter of this year, they also had more earnings than expected, and this is the last quarter, which hasn't finished yet, so that's why we don't have any value. But this is actually something good. If we want to know if Apple is behaving better than expected, well, we can take a look at this chart, and we're going to see if they are better or something else is happening. And if we scroll down, also we have this other chart, which is going to tell us how much revenue the company has and the earnings per revenue. We see here from 2018 to 2019 that they had less revenue. If we want to know what happened, well, we can Google it. We can ask Google why Apple's revenue for 2019 was lower than that of 2018, for example. and we're going to have our answer. And basically, this is a quick look at some of the numbers of the company, which is actually very important. And from here, we have a better understanding how the company is behaving, how the company is doing. And then we go to analysis. There are some experts that analyze the companies and they give like their expectations about the companies, and we can have that information. We can have this information here. So we have here this table, the earnings estimate. The information here is from last year, and this is the average. For example, for the current quarter, total number of 29 analysts, they estimated in average that the company is going to generate 0.7 earnings per share. For last year's, it was 0.76. So maybe because of the situation that we all know, they don't expect too much from this quarter. That's why they estimated a lower number than last year's. But if you see by the end of the year, for the last quarter, they estimated that the company is going to generate 1.37, which is higher than that of last year's, which was 1.25. For the current year, they estimate that the company is going to generate 3.24, which is higher than last year's. So this, for example, on the short term, this is telling me that analysts, they expect this company to behave even better than last year's. So this is something good because we can, like, for instance, we can say that on the short term, this company is going to generate more revenue than expected, which is good for the price of the share at the same time. And for next year, for this year, by the end, it's going to be, according to the analysts, 3.24. But by the end of the next year, they estimate that the average estimate is 3.86. Again, they expect a better behavior of the company by the end of next year. So we can say that for 1 year more, this company is going to generate more revenue than expected, more earnings than expected, which is something good. If we scroll down, we can see over here what the growth estimates are. So for the next year, this company, they estimate that it's going to be 19.10%, which is actually something good, and we can see this reflected in the earnings estimates. And for the next years, the average is 12.46%, which is actually really good. So if we are, for example, a short-term investor, we can say that for 1 year, this company is going to generate more than expected, which is something good for my investment. But for the long term also, this company is going to generate a lot, or at least it's going to be like behaving within the same range of numbers, meaning that for my long investment is going to be better because the price, more likely, because nothing is certain, more likely the price of the share is going to go up at the same time. So here on the right we have recommendation trends, another chart that I like a lot, because this is going to tell me if the price, basically given the current price of the company, which is this one, this is telling me if it is a good idea, at least for these experts, to buy shares of Apple, or to hold onto those shares if I already have shares, or to sell them. So for instance, here a lot of these analysts, they recommend to a strong buy, meaning that like it is a huge opportunity that right now, given the price is low, to buy more shares or to buy shares from this company. And a lot of them also, they recommend to hold those companies. If you are an investor of Apple, then basically you have to hold on to those shares. It's not a good idea to sell because they expect that the price is going to be higher in the future. And if you can see, none of them none of them is recommending to sell the shares, because like I said, we can see here, or we just saw in the growth estimates and the earnings estimates, and in the balance sheet we can see that this company is behaving really well. So it is not a good idea, unless you need cash, to sell off your shares of this company, because for the future they have like a bright future, and for instance the price of the share will keep increasing over time, which is good for us. And lastly, I like to go here to statistics, because since for those that didn't know, Apple also pays dividends, meaning that for every share that you have of this company is going to pay you some dividend. And if we want to know how much it's going to be, we can go to statistics and this section, dividends and splits. So it's going to tell us what is how much dividend this company is paying right now. So this is the value that we are looking for right now, and right now so far it is 0.78, meaning that for every share of Apple that we have, they are going to pay us 0.78 cents, which or it's equivalent in percentage, which is 0.68%. The payout ratio of the company is 23.73%. So out of the revenue this company is generating, they are going to take 23.73% and use it to pay the dividends to their investors. So this is really good, because it means that this company still has a lot of money to invest in the same company. If you want, like if you are like a long-term investor, you want the company you are investing in to improve their business, to develop more products or services and stuff like that, and they will need cash. So this is the way Apple is telling us that the money, some of the money, or in this case a lot of the money they have available, they are using it to invest in the same company and improve their business. And also we can see the dividend date. This is the date they will pay the dividend to their investors. This is the ex-dividend date, which is like the last day you have to have your share so you can have the right to receive that dividend. And well, basically this is all the information that we have about the dividend in this website. You can see you have more info here. So if you like want to really make a good analysis of the company, you can like see all this information, and it's going to tell you even more about the company. But like I said, we are going to go to the basics so you can have like an idea on how to analyze a company. So now we are going to go to this other website, which is Seeking Alpha, to look for more information about the dividends. And again, we can type in the name of the company, we select the value, and this is not a real price because I didn't refresh the page, but you can see here now it's showing us the right value. And so we go here to dividends. So we go here to dividends and dividend growth. It's going to show us the growth or the behavior of the dividend. So we have here the dividend history, and for example in 2012 the amount was 0.1892, and now it is 0.76. Well, last year was 0.76. So we can see here that they have increased the value of its dividend, of their dividend, by like 48 cents approximately, which is something good, because besides like investing in the company hoping that the price of the share is going to increase in the future, also you are being paid for holding on to those shares, and if they pay a lot, well, it's going to be better for your portfolio. And basically also we have We have here more information about the dividend. This is another chart for the last 5 years showing or displaying the behavior of the dividend as well. So we can clearly see that the company it's been increasing the value of the dividend, which is something good for investors like. So basically, this is the way I analyze companies. As you can see, we go through fundamentals of the company, we go into more details to understand what the business of the company is behaving like right now. And basically this is going to help us, like I said at the beginning, to reduce the risk of our investment, because if we notice that this company, the company we desire to invest in, is not, let's say, the balance sheet doesn't match, or they have too much debt and stuff like that, well, basically the risk is going to be higher. But if this company it behaves like Apple, for example, the level of uncertainty when investing is going to be less. So I recommend you not to stay only with what you saw in this video. You can go on the internet, on YouTube, and look for more tutorials so you can have a better understanding and you can still learn more about investing. This is going to help you a lot. So before we finish the video, please, if you like this video, hit the like button and subscribe to my channel. And also, if you have comments, please leave those comments in the comment section below. So thank you for watching and have a good one.